closing trades right here in 89 with me, Aisha Faridi, Nikunj Dalmia in the studios. And we're at the day's lows right now, although it started off quiet, tried or attempted to scale up and then finally caving in the dying minutes of trade. 117 points lower right now for the Nifty futures. Tata Motors, that's the one which is really cracking hard. We'll tell you all about that in just a bit. But 6.5%, no mean feat. That's the kind of cut that you're seeing on the futures alone for Tata Motors. 6% of a knockoff coming in on the stock right now. Oil and gas as well has really weighed heavy. The crude sensitives are the ones which are definitely the ones which are in focus. ONGC, which does not stand to benefit with crude, seeing a cool off. That stock is lower by 4% on the futures. But surprisingly, the OMCs, which actually do stand to benefit, they are also the ones which are cooling off. So BPCL is knocked down about 2.25% right now as I speak. The other key pressure points being an L&T, M&M, which is down nearly 2%, SBI down 1%, and technology as well has fizzled out from what it was seeing the past many trading sessions. Very quickly then, the breadth of the market also not looking in ship shape. 119 is the count to the declines within the F&O universe, with 65 to the ups right now. We were chatting about Tata Motors. BMW has revised their guidance. And it's cut in the 2024 guidance in the automotive segment that they projected. They're saying that the EBIT margins are at 6 to 7% is what they're going to clock from the earlier 8 to 10%. They're stating muted demand in China, which is impacting sales volumes. And that's not going to augur well, perhaps, for the sentiment on JLR for Tata Motors. UBS is saying it's a sell for Tata Motors, a target of 825. The stock currently at 977. They're saying JLR has had a good run over the past few years, but strong demand for JLR's launches is also that they're seeing. But Range Rover, a sports sharp discount, has actually seen a spike. So a little hazy when it comes to Tata Motors. Having said that, the crude beneficiaries, they are the ones which are springing up, and Paints continues to see that that boundless move. So be it a Berger or an Asian Paints, those stocks continue to see gains for themselves. Dixon, that's the other stock which is in focus. CLSA has maintained a hold. They've upped the target price now to 12,100 from the earlier 11,400. They've outlined a very strong near as well as medium-term growth outlook, and that's something that the brokerage likes. Just want to mark what the global markets as well are up to. While it's the US inflation data, which is awaited overnight, it's a bit of a mixed bag across the European street. But if you were to just look at US futures, they're not in the best shape right now. Dow futures are lower by 160 points. S&P futures as well mildly soft right now, and NASDAQ futures as well are down over 80 points as we speak. So I guess seeing that little bit of a rub off. But overall, the macro construct, Nikunj, like we were debating about in the morning, that really doesn't change. In fact, if nothing, a crude cooling off sub 70 acts as a big tailwind.
Yeah, just because it's a tailwind does not mean markets will also rally. Equity markets, sometimes they rally ahead, sometimes they rally afterwards. There is an element of profit booking which cannot be ruled out today. I think from the eyes of Nifty, it is very subtle. But from the eyes of what's happening in PSUs, the way how banks, how autos in a sense are getting logjam, how a lot of these other sectors which essentially have been the leaders, defense, railways, how they are going through what could be called a sectoral rotation. Metals have corrected, OMCs are not participating. So the fervor in the market, what is called as momentum, the fervor in the market and the momentum in the market clearly seems to be missing, at least for the moment.
Yeah, absolutely. Okay, let's bring on board our chartists and figure out which way the Nifty and the markets are going to head. We've got Naresh Mirani on the show with us. Shibani Sarkar Korean is going to be joining in on the fundamentals. But Naresh, let me just come to you first. What is this cool off indicating, and a sudden one at that?
So we continue to be sluggish, one day up, one day down. That continues globally as well. We are at the same place where we were in the mid of July. The indices are at 25,000, which is where they first hit, roughly closer to that mark. Every day, what we see is some bit of a rotation. But the fact remains, a lot of sectors have come off quite a bit. So if you look at a PSU bank, that has come back to June election lows. And then you have something like IT, pharma, FMCG, which are up 15 to 25% from that point of time. So from here on, you need some other sectors to actually keep on holding the markets in positive momentum. So only FMCG is something which looks like a breakout. IT and pharma could take a pause given the rally. And till the time we don't see banks participating, we are in the sluggish move wherein 24,600 should act as a support and 25,200 to act as a resistance.
Shivani Sarkar joins us now. Let's connect with Shivani and let's take our conversation forward. She, of course, is Executive Vice President and Fund Manager with Kotak Asset Management Company. Shivani, it's a day when you would have said that everything was right for India, right? Crude is down, FIs have started buying, global cues were decent. Yet markets are showing tremendous signs of fatigue. And keep Nifty out of this situation, the breath has been rather poor actually.
Yeah, hi, Nikunj. So, of course, our markets have had a great run. Markets have outperformed the emerging market pack by a mile. But like you rightly pointed out, that if you look at the fundamentals of the market, whether it be in terms of macro or earnings, they are largely where we were and largely stable. There are a few key things that we need to keep in mind for the market. When we look at our earnings trajectory on a YOY basis and you look at quarterly earnings trends, the quarterly earnings trends have come off a bit. And even in the last quarter, while numbers were largely in line with estimates, the estimates itself were muted. Now for FY25, the earnings estimates are still in the range of about 10 to 12%, which means that for the second half of the year, earnings needs to pick up, especially coinciding with the festive season. So there is an expectation of earnings improvement going into the second half of the year, and that needs to play out for our markets. Now, when you look at globally, clearly there are events that are lined up which the markets are watching out for. First and foremost, what happens in terms of the Fed and the September meeting, and whether the Fed embarks on the rate cut cycle. Geopolitical risks remain. And from that construct, when you look at our markets, it's possible that we do see some near-term volatility simply because we have outperformed in a big way. But the fundamental drivers of the market in terms of earnings, macro, and flows remain largely intact. What we have been really saying is that in this market, one has to be mindful of valuations, look at quality companies trading at reasonable valuations rather than chasing momentum, be somewhat overweight on large caps where there is still risk return in your favor from a valuation perspective. And finally, avoid companies which have low free float, where liquidity is low, but where earnings have moved up significantly ahead of, the valuations have moved up significantly ahead of earnings. So these are pockets which we will keep a close eye on and will avoid certain segments where valuations are looking expensive or stretched.
That's exactly what I wanted to probe about further. What is it that's on your avoid list right now, where there is clearly valuation discomfort?
So when you look at the market in the pockets of large cap, mid cap, and small cap, we've always said that if you look at large cap from a long term valuation perspective, large caps are trading at a slight premium to their long term history, and therefore that premium seems to be reasonable in context of earnings growth. For mid and small caps, while earnings has been higher than large caps, valuations are also at a significant premium to their own history as well as to large caps. So the way we are approaching the markets is obviously the risk reward seems to be in favor of large caps. Within mid caps and small caps, one has to be extremely stock specific in nature and avoid companies where, again, as we were discussing in the previous question, multiples have re-rated significantly ahead of fundamentals. From a sector perspective, if you look at, and you ask me where valuations are still reasonable, there are two segments where we are keeping a close watch on. One is the consumer space, especially on staples and even some pockets of mass discretionary consumption, where valuations in context of their own history seem to be still reasonable. And there are signs that some amount of demand revival is taking place, especially given the rural and the mass consumption trends on data that we track. The second is on large cap IT, while mid cap IT is clearly trading at multiples which are again fairly expensive with respect to history. Large cap IT multiples, though not significantly cheap, are not extremely expensive either. And the third pocket that we will keep a watch out for is banks, specifically some of the large private sector banks, where valuations are very reasonable as in context of their return ratio profile and ROE profile. Though near term, the sector does have headwinds in terms of slowing credit growth, margin pressure, as well as some inch up on credit costs. So from a valuation perspective, technology, consumer, and to some extent banks seem to be favorable at this point in time.
Nuresh, just to put things in context for the Bank Nifty, I think this is another failed start. Can I say that? Every time it appears that the Bank Nifty is getting ready for a launch, it just fails to have follow-up buying.
So we've not seen more than a couple of days of outperformance of Bank Nifty for a really long time. Day before we saw one of those days where Bank Nifty outperformed, but the next day it flopped out. Right now also it's the same. It's just that it is no more correcting in a major way. And say if you look at the highs, the Nifty is just say 1% away. The Bank Nifty is now almost closer to 4-5% away from an all-time high or even more. Once we sustain above 51,800, that would be an indication. On the downside, 50,000, 50,500 is a support. So it's near the band of total sideways movement. And if you look at the large banks, you hardly see any volatility. If you look at pick up a HDFC Bank, look at today's price and maybe look at 2 months back price, it would be the same. 2 years back, almost the same. 4 years back, almost the same. So eventually this should catch up. Post-COVID, this is the longest time Nifty Bank has underperformed in the last 10-15 years as such. So at some point of time, we could see a reversal to mean. As of now, would wait for prices to confirm that. But yes, at current levels, banks have underperformed majorly and could actually catch up over the next 6 to 12 months.
On that note, let's take a very quick break. Haven't seen much of a recovery actually play out. We're still pretty much around the session lows. With the Nifty still down about almost 90 odd points, and we're sub that 25,000 mark. Quick break. When we come back, lots more on the markets. Tata Motors, that's been the one stock which is bleeding in trade while the market also is struggling at the session lows. The Nifty alone is down about 0.5% and Tata Motors lower by a good 6%. Why is the stock low? BMW has actually cut their guidance, but what's the linkage between that? Let me take it across to Soumit and understand exactly the same.
Well, Tata Motors remains in focus on the back of a couple of news. Firstly, BMW, which is a luxury car, has given a warning when it comes to the 2024 guidance. They have cut the 2024 guidance for the automotive segment. They have also lowered the margins, and they are saying that China, which remains a key market, they are seeing some muted demand on that front. Now, China also remains a key market and the most profitable market, in fact, for Tata Motors JLR division. So, hence, this could have a negative bearing or a negative impact on Tata Motors as well. Apart from that, UBS has also come out with this note where they have maintained their sell rating on Tata Motors with a target price of close to around 825 rupees, and they are saying that the discounts when it comes to Range Rover has seen a sharp spike in the last few months. They are saying that earlier the discounts were, for JLR models were near zero, which has now started to increase because of lower demand. So that is also one of the major concerns coming in for Tata Motors. They are also saying that rising discounts, moderating growth and lack of new hybrid or normal petrol diesel engines could result into a significantly lower financial performance for Tata Motors in FY26. Apart from that, they are also saying that earlier Tata Motors had a good run on the back of new launches. However, that is expected to now slow down going forward. Hence, multiple concerns coming in for Tata Motors, and as you can see, the stock is also down around 5% in trade.
Joins us. Let's take a conversation forward in terms of the technicals and where markets are headed. And Srikanth, what do you make of the current market action? We've spent a lot of time in and around 25,000, almost a month now.
Yeah, I think good afternoon, everyone. Very first, Nifty is consolidating, but at the same time, it is forming some bearish sort of formation at the around near this particular highest point of the rally. So which clearly indicates that there is a good amount of cautious kind of approach from traders. They are not participating in this particular move, and based on technical formation, I think again we can revisit the levels of minimum 24,750, which was the recent low. But while looking at the entire setup of other heavyweight stocks, I am of the view that markets are ready to move towards 24,500 or 24,400 in the near term. So it's a corrective pattern that we can see, but yes, we can see some correction from here.
Shivani, what is your own sense on how you're reading Tata Motors? The fact that BMW revised the guidance, but the price is being paid by Tata Motors today.
Yeah, so if you look at the auto space, our view on the auto sector, and we've been positive on the sector for a while, has been more premised on what's happening at the domestic side of the business, where growth has clearly been one of the key drivers. Now, today, if you look at the entire auto space and you divide it into parts such as the passenger vehicle segment, the two-wheeler, as well as the CV space, our preference at this point in time is for the domestic two-wheeler segment, specifically because of the data trends that seem to point that some amount of revival is in the offing, especially where rural demand is concerned and demand at the bottom of the pyramid or mass consumption, which again benefits the two-wheeler space, specifically in the mass segment. One key factor to watch out for will, of course, be the festive season and how demand pans out. Our thesis is that with monsoons being normal, some amount of government spending coming back on track, the overall wage growth, especially where rural or bottom of the pyramid is concerned, is seeing some amount of recovery, and that is likely to drive demand, both for the passenger vehicle segment, the mass segments, as well as the two-wheeler space. And in this overall construct, of course, the two-wheeler segment appears to be well placed, both in terms of growth outlook as well as valuations. The other icing on the cake for this space will, of course, be commodity prices, which have been benign, which means that at least from a margin perspective, margins should remain largely stable. So I think overall, our view on auto remains fairly positive, primarily based on the domestic demand trends, specifically on the two-wheeler space, and that's how we are positioned in our portfolios.
But is there a case for slowdown in cars, and it's a matter of time? Do you think the four-wheelers will start coming down, Maruti or for that matter Mahindra and Mahindra, because the car sales are no longer even growing in double digit. In fact, they are growing at a rate which is lower than the GDP now.
Yes, so Nikun, so what's been happening in the car space is specifically, post-COVID, there was a significant trend in terms of premiumization. And we saw that the upper end segment and the SUV segment saw significant growth while the mass segment lagged behind and still possibly in terms of numbers lagging behind. Today, if you look at the numbers on volume data, there has been a slowdown and there has also been some amount of inventory build up in the channel, and discounting has also increased specifically on the passenger vehicle space. So that is something that we will watch out for. Our belief is that those players which do have a series of product launches and also players which are present now more in the mass space will possibly be better positioned in the passenger vehicle space, given our thesis that some of the rural demand, the mass segment demand, that demand is coming back. And therefore, this wide gap that you saw in terms of premiumization and the upper end segment growing significantly faster than the mass segment should start to narrow where some of the passenger vehicles are concerned. But by and large, our thesis across has been that with good monsoons, if you look at even the crop sowing pattern, spending by government in terms of post-election spend, the thrust on the rural or bottom of the pyramid should lead to improvement in demand. And of course, the festive season helps in that context as well.
Okay, Shivani, stay with us. On one hand, while you're seeing a cool off in the auto segment led by Tata Motors, similarly, what's actually holding up is paints, given that they're definitely the crude sensitives and beneficiaries today, pretty resilient as opposed to what the rest of the market is doing. Let's try and understand what the cool off in crude really implies for paint companies individually. Samit is here with that data.
Well, if you look at Brent crude prices, they have come off sharply from $85 that we had seen on an average in the first quarter to now below $70 in the second quarter. Now, this will definitely benefit paint given the fact that nearly 40% of the raw material cost is either directly or indirectly related to crude or their derivatives. So, if whenever crude prices fall, the prices of the derivatives also fall. Obviously, there's a lag impact. So, most likely in the second quarter, we won't see the margin benefit coming in for the paint companies, but in Q3 and Q4, if prices continue to remain at a lower level, we'll definitely see the margin benefit kicking in for the paint companies. Now, this is more important for the paint companies given the fact that there was a competitive pricing scenario going on in the industry. So, this drop in crude oil prices will provide them the much wanted relief when it comes to on the margin front, given the fact that they won't have to, their margins could remain more or less on the same level given the fact that raw material prices have come down. So, that's more important coming in for the paint companies. Also, what we are understanding is that from channel checks is that the competitive environment is also a bit easing down, given the fact that the new player, that is Birla Opus, is not going that aggressive right now in the market. However, the pricing pressure continues in the market, and this drop in crude oil prices will provide the margin relief coming in for the paint companies going forward.
That, in fact, we'll pick up on that discussion on paints, but on the other side of this very quick break. Back to closing trades right here on ET Now. Still under pressure for the markets. Even the breadth hasn't seen any improvement. We're down 0.5%. And status quo pretty much, 150 points low on the Nifty futures. Tata Motors, ONGC, Hindalco, BPCL, L&T and SBI, they are your key pressure points. In fact, if you bring up the intraday chart of SBI, it's given up almost 1% or 0.8% roughly in just the last few odd minutes or so. It wasn't as weak just a short while back, but now SBI alone is cracking a good 2% and weighing heavy on the index. But here's an excerpt of an exclusive chat that we had. Prakash Priyadarshi, my colleague, caught up with the Shipping Secretary T.K. Ramachandran on the government's new policies to introduce major reforms for the shipping industry.
So we are looking at the entire value chain, and the value chain starts with financing, insurance, ownership, leasing, chartering, arbitration, shipbuilding, ship repairs, and then of course flagging, and so on. You know, the entire value chain, we are looking at this operations, of course. So in this...
it also includes ship manufacturing.
Yeah, building. So shipbuilding, repair, recycling, the entire value chain, which is where we are, trying to concentrate. And the thing is that in many of these areas, we've not been really there. We are just 1% in the world's tonnage. Similarly, we build less than 1% of the world's ships annually. And even on repairs, our ships go abroad for repairs. A large percent of our ships go abroad for repairs. Therefore, we want to create the ecosystem in India, and so we are working towards that.
And how the private participation would be ensured?
Yeah, so entirely driven by private participation. So there are certain schemes which will ensure that the funding support is given to shipyards on the demand side. On the supply side, and on the demand side, we are ensuring that there is aggregation of demand, so that there is demand assurance, there is demand visibility, and so that over a long term, the shipyards can produce the designs that are required by our industry, and they can be produced locally.
Okay, and you are also talking about the formation of SPV. How will it work?
Yeah, so SPVs basically will be a joint venture between the producer of the cargo, the consumer of the cargo, the operator and the ship owner. So all of them get together so that they are able to use the ship that they own for the kind of cargo movement that is required by India.
Anshul Sehgal joins us now. Anshul, what do you make of the market setup? I mean, everything is just going our way. First it was crude, now it are flows, and now the recovery in rural India.
Good afternoon, Nikunj bhai. Yes, it's an interesting market. Rural economy has been weak for the better part of the last 4 years. Individual households have been filling their pockets, ensuring that their savings are recovered before they go out and spend. And for that reason, that market has been weak. But we are at a cusp, we believe, at this moment, where this market is likely to turn. Initial signs have been seen over the last 2 quarters in company results. FMCG company after company is indicating that there is a turn in that segment of the market. And what is interesting is that while this market has been going one way and that is up, many of these rural discretionary companies have been at multi-year lows. So that is where, in our judgment, there is an opportunity where once the rural economy turns and the tide lifts all boats, these companies will be beneficiaries as well. So there are opportunities in this market. Of course, you will have to be a discerning investor to take advantage of those opportunities.
Wondering where you're finding those opportunities right now, Anshul?
Aisha, if you look at many of these say shoe companies, shoe retailers, etc. I mean, just look at their prices. They've really gone nowhere over a really long period of time. Some of the retailers have rallied off late, but again, those retailers had consolidated again for the last 3-4 years, after which they rallied off late. Even the FMCG companies, as you may have seen, may have noticed, the index has post the election results, the index has turned, and I think if my memory serves me right, from that day to today, it's up between 15 and 20%. That again tells you that there is tailwinds in that segment. So in our judgment, all of these pockets are where there is opportunity. These are, while there is opportunity all around, but you've got to look for opportunities where the risk reward is favorable. And that's what we find in this segment.
You were very bullish on manufacturing. Are you now turning less bullish on manufacturing and more bullish on FMCG?
I wouldn't paint that with a broad brush, Nikunj bhai. I would say that there are within manufacturing, there are still opportunities, but the meat of the market is behind. Most of the money has been made. You will have to work very hard to find that odd opportunity now, where there will be money made going forward. I do think that for the smart investor, there is opportunity. He can find opportunity in the manufacturing space, but it's not as easy as it was, say, 1 to 2 years back. It will have to be a stock by stock opportunity going forward, and for that reason, it is not just manufacturing. You'll find that opportunity across the market.
You know, CapEx, that's been one theme which has really been dominant all through this entire year, if not before. And we also spoke with Vinay Chatterjee, founder and managing trustee at the InfraVision Foundation, to just really try and understand whether or not there is any pickup in private CapEx, and whether the government as well is going to continue with CapEx at this current run rate or not.
Thermal, renewable, transmission, distribution with smart meters, pump storage, airports, Jewar, Navi Mumbai. These are all happening sectors. In social infra, if you see healthcare, real estate, and now the announcement of new industrial cities. If you see some marquee announcements, there have been the announcements on chips, on mobile manufacture, on batteries with Ambani's, on digital. There is a boom in data centers. And as I said, there's massive investments happening, announced on chips, mobiles, electronics, batteries, etc. So it is happening. Surprise of surprise, the boom sector is defense. You should actually, analyze the order book of defense companies and the two thrusts that India has now embarked on, which is to substitute imports for domestic manufacture and to push defense exports. The increase in private sector capex from 34.1 to 34.9 is hardly worth going to town about. But the fact is that even that this increase has happened because of the sudden emergence of non-traditional sectors, which has at least led to some degree of positivism. Defense, healthcare, power, very clear, and real estate, of course. It's across India's towns and cities, buildings are coming up, real estate is moving. Nominal GDP is growing at 12%, but the cement sector is even less than nominal GDP growth. Am I right? So therefore, it substantiates the hypothesis that we are seeing a structural change in the Indian economy, structural change in investment patterns, where new sectors are emerging. Old sectors are growing at a far lesser space in terms of capex. But the new sectors are not large enough to dominate the overall capex story. Anything to do with traditional and non-traditional power. The companies that are in coal thermal are going to see boom times because there's going to be a demand-supply imbalance in favor of producers. So anything to do with the power sector and renewables, green, of course, is in boom times on investment.
Anshul, when you say that the rural economy is showing signs of recovery, what is the best way apart from staples? Could two-wheeler be a bet? Could consumer discretionary be a bet? Could microfinance be a bet? We always think rural economy means soap, sabun, shampoo. I mean, there are more categories than that, right?
That's right. You're right. Consumer staples is definitely an option. Within that, again, you will have to be discerning. There are various sub-segments within consumer staples. You will have to look for the sub-segment which is most sticky. For instance, if you look at say air conditioners, air conditioners are a basic necessity now. They are not like a luxury anymore. So when people have monies, they want to first spend on air conditioning and make their lives slightly more comfortable. On the other hand, you know, an ironing rod that people may defer the purchase of. So one will have to look for sub-segments where growth is trending upwards and there are tailwinds. Of course, if you look at microfinance as well, that is a space, interesting space again, because again, that is a space where valuations remain reasonable. Over the last 1 year, we've seen many of these microfinance companies really not participate in the rally that we are seeing in the broader markets. And growth trends are starting to pick up. They have enough capital on their books. I think that is an interesting space as well, where if growth picks up, as we anticipate it will, then there will be upsides on valuations and risk reward remains favorable. So you're right, multiple subsegments within the rural economy where one can make decent returns on a risk reward basis.
Strategies in this market. One, you move out of high beta, high momentum, maybe those richly priced consumer, richly priced fintech stocks, defense stocks, and move into defensive and staples. And the other idea is that you buy these stocks maybe on a bad patch, maybe on a bigger decline, and sit on cash. What is a better strategy? Do you think the leadership in the market is changing, or cash is a bad idea in this market?
Depends on who you are. If you are an individual shareholder, individual investor, then for you, absolute returns becomes, or an absolute return strategy is what you follow. And in that event, since you've made so much money over the last few years, sitting on cash may not be a bad strategy. But if you're a professional portfolio manager, then your aim is, of course, to maximize alpha over the index. And in that context, holding cash can be a double-edged sword. It may work for you, it may not work for you. Hence, in that situation, it may be better to not hold cash, but hold cash proxies. For instance, large caps, hold defensives in large caps, things like that, where downsides may be limited. So that is a strategy that one could follow. Although, if you ask me, and what I would do, typically I'm someone who follows many of the things that Druckenmiller says. And one thing that he says is that when you're having a good year, the tendency is to book profits and hold cash or be defensive. But it is then that you should be stepping on the pedal and going for the home run. And given how this year has gone, the tendency by now is to really hold cash, take some profits off the table. But I would say that if you're again a smart investor, this is the time to actually press on the pedal, because between now and year end, you may see certain segments of the market deliver outsized returns even from here.
Very interesting thing. I mean, all of us love to know more about Stanley Druckenmiller and his style. And if we are talking about the grand finale of putting the metal pedal to the metal, and if the last hurrah in this market left, where is that going to get captured, and what is the best way to capture it?
Nikunj, I don't think that there is any one answer to this. I would modulate the answer in two subsegments. One is that first, you've got to be cautious in segments, like you rightly said, in segments which are overheated, where there is excessive interest from the markets. Fintech, for instance, may be one of those segments. Defense clearly is one segment where there is excessive interest. There are other segments like railway PSUs where there is a lot of interest. These are spaces that one will have to be slightly cautious in. However, there are other pockets, as I mentioned, discretionary rural-linked companies, ethanol-linked companies, alcohol-linked companies, certain FMCG companies, where even media, for instance, and certain segments within media where there isn't significant interest, those are segments where there will be money made between now and year end. Even logistics, I think that within that there are very interesting opportunities which will generate handsome risk-adjusted returns going forward as well. And I'll give you an instance, Nikunj, if you give me a minute, and I'm not pulling you too far. Look at the last week itself. For nearly 1 year, you had alternate fuel companies go down because of some government action, which was that they had taken away broken rice as raw material for these ethanol companies. Now, one decision of the government to allow this broken rice to be purchased as raw material has re-rated these companies immensely. In fact, some companies are up 40% in just 1 week. My point being that if you are in the right pockets, even a market which is stable to going nowhere, you will find opportunity and where there will be money made. Even a bear market is a very narrow bull market. If 1,000 stocks are down, there will be 50 which will be up. So for you to be to be identifying those 50 is really the game. And that's what I think. I've named some segments. I think that there are opportunities in this market to make money for smart investors.
About 13 minutes left. I'm going to go back to Naresh and get some ideas. Naresh, it's turning out to be not ugly, but a very non-inspirational day. And for the first time, you've not really taken advantage of global cues. And Naresh, frankly, the market, whichever way you look at it, Nifty has been just hugging on to a flat line from last, 6 weeks almost now?
So it's been 6 to 8 weeks, say mid of July, we hit 24,800, 25,000 mark. And we are now almost in mid of September, and we are at the same place. We got this one crack during the yen carry trade. And if you look at it right now, the yen is below those prices and we are still much higher. So, but we've gone nowhere in terms of the index. But there has been a huge, say, divergence in terms of stock price movements. So you have PSU banks at election day lows. You have the Nifty IT up 15 to 25%. You have the pharma up 25% from those times. You have the Nifty FMCG up 15%. So these three sectors were not in the reckoning in terms of, say, election beneficiary, etc., contrarian bids that have gone up. And you have defense, PSU banks, capital goods, which have corrected 10 to 15%. So there has been a huge divergence in terms of leading and lagging sectors. And in between, you have banks which have gone nowhere for many months together. So for now, it becomes a boring market because there is no follow-up price action in any of the moves. Even the trending moves have been slow and steady. So a pharma has been slow and steady. You have insurance, which is slow and steady. FMCG is slow and steady. We are not seeing moves wherein a stock moves up 8-10% in a day.
Okay, that's the take coming in on some of the stocks. In the meantime, just taking a look at the pressure points as well. Naresh, we haven't talked about Tata Motors specifically. I mean, it's a huge crack on the stock. It's down about over 6% right now in the futures. Big breakdown. Do you see some more follow-through selling coming in the coming days?
So after today's crack, it makes it more clear that the momentum has shifted. Until now, it was sideways. We had two false starts around that 1100 to 1150 mark. Now closer to 900, 950 is the major support, which is where it bottomed out in the last 6 to 8 months. So for now, at current levels, not very interesting. Would wait out for further declines and maybe look out for a bounce back trade from 900, 950 mark.
Better off avoiding global sectors because the selling in crude, decline in commodities, crack in bond yields, Fed cutting interest rates, this cannot be in coincidence. I mean, if one read in between lines, this is a clear sign that today or tomorrow a slowdown concern will hit us.
Is that for me?
That's right.
That is right. Clearly, there are signs of slowdown concerns. However, I am one to not really take market calls basis with the macro. I still recall that in March of last year, when I was speaking with fund managers across the industry, everyone was saying that this is the small and mid cap segment of the market is heated up, and so one should shift to large caps. From there to now, we've seen nearly 70 to 80% rally in the small and mid caps. We don't have market moves in our control. The only two things that we have in our control is buying quality names, um, companies which are healthy in their current operations and where the future looks bright, and buying those companies at reasonable valuations. Thereafter, what happens in the markets is beyond our control. And definitely the macros can work one way or the other. On a day, you can get the same news making the markets react in a different manner, on another day, the different manner. So I think that we should really focus on those two aspects, buying quality at reasonable prices. And then if there is any volatility in the markets, then just bear it. Of course, asset allocation is something that each investor should do, and that will allow the investor to buy more if there is volatility. But I'm not one for taking market calls basis the macro.
So you will not assume that the world is going to hit a speed bump and it's time to cash out. You would stick to your positions and you would stay invested. But what about global facing sectors? Would you, if you have invested in metals, let's say pharma or IT, would you stick to them as well?
I would definitely. I'm positive on the pharma space on a stock by stock basis. I think that there, even the recent Biosecure Act in the US will throw up a lot of opportunity for Indian companies, US companies. The Chinese CDMO companies are between 20 and 30 times the size of the Indian industry. So even a 10-20% shift from there to India will mean the industry doubles. I think that there is significant opportunity for India in the CDMO space, the pharma space. On even in IT, I would say that IT in general looks expensive. I think that leading companies which used to trade at between 15 and 20 times earnings now trade at between 25 and 30 times earnings. I think that space is expensive. Of course, if you're wanting to hide, then that is you want to be in a defensive space, then clearly that is a space to be in. But by and large, I think that space is expensive. So I wouldn't enter a space again basis the macro outlook for that space. I would enter it if the risk reward is favorable, valuations versus growth is favorable to me as a buyer.
Just earlier today, we were also chatting with Sandeep Tandon from Quant Mutual Fund, and here's his opinion on the markets, and of course, a lot of other concerns regarding, the regulatory concerns regarding the functioning of his mutual funds. Here's what he had to say.
Current quarter between July to September will be the most volatile quarter in the FY 2024. Okay. And when we saying that why it should be volatile, because we have been talking about cross asset, cross market volatility should spike, and the background of geopolitical volatility, currency volatility, which means world is not going to be stable in this period. And that's one of the precise reason in last 3 months, our portfolio, if you look at, is more skewed toward defensive side. And we still maintain that this cycle has still not ended. Let's say FMCG is a space which has been underperforming for a while. Okay, that's a space we have built our exposure. Valuation was not cheap, but they started trading in a neglected territory, and hence that was the play. So is the case with pharma, and so is the case with insurance, and so is the case with some of the healthcare space. So these are the areas which we remain very constructive, and I'm saying that even sometimes you have to underperform a bit. It should be a part of a strategy, but let's play safe when we see data points are showcasing that things are going to be more volatile. So I like to play safe through these sectors. Business is back to normal. Okay, we are seeing continuous inflow. You have seen that recently we have crossed 1 lakh crore mark. So we are one of the, I don't think in any mutual fund industry anybody has grown this sort of size in 4 years. So that's a big achievement, and I think that credit goes to a lot of retail support which we got, because we are predominantly a large retail house. So a lot of support came from tier 2 cities also, and B30 beyond 30s also. So it's very important that Whether Quant brand has been established among masses, answer is yes. It's a very trusted brand which we have created. And what is very important is an asset-light model we run without any branches, without big sales force. We have able to generate. So this business is all about performance, performance, and performance.
Okay, some words coming in from Sandeep Tandon. In the meantime, as we begin winding up for the day, let me also get in some BTST trades. Naresh, what's on your buy today, sell tomorrow list, or is it the other way around?
Still a buy today, sell tomorrow list, more of defensives. First is a buy on Max Financial Services, new 52-week higher, very close to an all-time high. A stop loss at 1135, target price of 1180. Second is a buy on ITC, again hit a new all-time high today, stop loss at 510, target price of 525.
Okay, those are some BTST ideas there. Look at Bajaj Auto though. That's the one which is scaling up quite nicely. Paints, of course, as the segment is looking very good. Anshul didn't talk about that. You know, paints as a category has really been subdued ever since, you know, Birla's gotten into the game. There were a lot of heightened concerns around competition heating up in the sector. And of course, valuations also were bloated. Now they seem to be coming out across the board along with the big tailwind of crude from that sort of hibernation that these stocks were in. You think there's merit in looking at these?
Aisha, in my experience, for stocks to rally consistently, they need to show revenue growth. Minor moves can happen because of margin expansion, but for stocks to continue the rally that they've seen in recent times, revenue growth has to pick up. And in this space, I fear that there is going to be intense competition. There are two large players who are entering this space, who are only just entering this space. And, you know, in terms of quality, I don't think that there will be much to differentiate between one from the other. And the pricing differential can lead to many buyers moving away from the incumbent players to these new players. You know, the incumbent players trade at very hefty margins, 20+% EBITDA margins, and which gives them around 30% ROEs. A little bit of compression in those you know, metrics can lead to multiples compressing meaningfully. And I don't think that the raw material pressure easing off is something that will be a consistent factor for these stocks to rally. That may be a trade that may play out for some time, but thereafter it will have to be volume growth for each individual company for the stocks to rally, which in my judgment looks some time away even from here.
Okay, Anshul, we'll let you go on that note. Naresh, good to have you on the show as well. Let's begin winding up for the day, and we've definitely closed in with some amount of disappointment given that the start was only about, you know, very muted, picked up from there, and then we've seen nearly about a 2% fall actually from the top of the day. 135 points lower, sub the 25,000 mark. That's where we're shutting shop for the day. Tata Motors, along with ONGC, Wipro, Hindalco, L&T, BPCL, Adani Enterprises, these have been the key laggards from amidst the large gaps. SBI as well, you know, saw a huge contribution in the losses today, as did Reliance Industries, which is closed in with a 1% fall along with M&M. On the flip side though, big gains for Bajaj Auto, held out by 4%. Asian Paints, of course, held out very nicely. And then there was Bajaj Finance and Britannia as well, which have had a decent day for themselves. Wasn't as pleasant for the broader end of the market as well. There too, we've closed in with a ratio of about 2:1. When it comes to the breadth of the market. And there too, there was Aarti Industries down about 4.5%, MGL lost about 3.25%, JNFC was down about almost 4%. Even the crude beneficiaries caved in today's trading session. But yes, Paints held out, Page Industries, Canfin and Dixon, they were the movers today. But that's pretty much it. It's a goodbye from Nikunj and me, and we'll see you again with market action tomorrow morning at 8 a.m.